Welcome back to Upgrade Your Life. Money laundering, at its essence, is the process by which illicitly obtained funds are made to appear legal, essentially cleaning them of their suspicious origins. While the term may evoke images of shady deals and dark alleys, the truth is that money laundering often employs sophisticated methods, taking advantage of global financial systems and modern technologies. Here's a deep dive into how this illegal operation functions. Before we delve deeper, hit subscribe if you appreciate our content. The 3 stages of money laundering. Placement. This is the initial stage where the dirty money first enters the financial system. It might be done by breaking up large amounts of cash into less conspicuous smaller sums that are then deposited separately, to evade suspicion. Alternatively, it could involve purchasing assets or simply using the money to gamble. Layering. This is arguably the most complex phase. Here, the goal is to obscure the origins of the money. This might be done by moving the money through a series of complex transfers, withdrawing and redepositing it, changing its form through purchases and sales of assets, or simply withdrawing and depositing it at various banks across the globe. Integration. This is the final phase where the cleaned money is integrated into the legitimate financial system, and its illicit origin is difficult to detect. This might involve investing the funds in legal business ventures or purchasing high-value items. The rise of cryptocurrencies like Bitcoin has given money launderers new tools. While cryptocurrencies can be used for a plethora of legal transactions, their relative anonymity makes them attractive for money laundering. Digital wallets and online pseudonyms can obscure transaction trails, although exchanges and governments are ramping up efforts to counteract this. For example, Jane has some money she wants to hide. She knows that cryptocurrencies can help with that due to their digital nature and often anonymous features. Initial purchase. Jane buys various cryptocurrencies on exchanges that don't ask too many questions about who she is. Mixing. Jane uses a crypto mixer that jumbles her digital coins with others, making them harder to trace back to her. Switcheroo. She swaps her mixed coins for privacy-focused ones like Monero, which hide transaction details. Final exchange. After some time, she trades her privacy coins back to popular ones like Bitcoin, then sells them on standard exchanges, converting them to regular money. To most, it looks like Jane just did some regular crypto trading. But in truth, she cleverly moved her money in a way that hid its origins. Shell companies and offshore accounts. Establishing companies in regions with strong financial secrecy laws can be an effective laundering method. These shell companies can exist solely on paper but can handle large sums of money, making transactions that seem legitimate but are actually designed to launder money. Meet Artful Dodger. He's accumulated a lot of money he doesn't want authorities to trace. He's heard about shell companies and thinks it might be the perfect solution. Setting the stage, Dodger selects a tax haven with lax regulations and strong financial secrecy laws. Let's say, the British Virgin Islands. He contacts a local law firm there that sets up shell companies for a fee. Paper Empire. With the law firm's help, he establishes Dodger Holdings Limited. It has no office, no employees, and conducts no real business. On paper, it's a consultancy firm. Banking in secrecy. Dodger then opens a bank account in the name of Dodger Holdings Limited, in another tax haven, perhaps in Switzerland. He deposits his money into this account. The fake transactions. He contracts fictitious consultancy services to another company he owns in a different country, paying hefty sums. This money transfer, in essence, is money laundering. But to any observer, it seems like a legitimate business payment. Reaping the benefits. Over time, Dodger accesses his money through the bank account of Dodger Holdings Limited, making it appear as legitimate business profit. To the world, Artful Dodger is a successful businessman with an international consultancy. Little do they know about the intricate web he's spun to clean his money. Trade-based laundering. By manipulating invoices in international trade, launderers can move money across borders. For example, by over-invoicing for a shipment of goods, a company can move extra money into a country, using the legitimate trade as a cover. For example, Crafty has been making a killing in illegal dealings and needs a way to legitimize his ill-gotten gains. Setting the scene. Crafty has a sneaker business in country A and a partner, Sly, with a storefront in country B. The over-invoicing trick. Crafty decides to ship 1,000 pairs of sneakers to Sly's store. Each sneaker costs $50, but in their paperwork, they list each sneaker's value as $100. Sly pays Crafty $100,000 for a shipment that's truly worth only $50,000. The extra cash. Now, Crafty has an extra $50,000 he's moved from his illegal activities in Country B to his business account in Country A, seemingly from a legitimate sale. Legitimizing the money. On paper, Crafty's company is booming. He's selling sneakers like hotcakes, at least, according to the invoices. The money is accounted for as legitimate business revenue. Reaping the rewards. With his profits from the sneaker sales, Crafty invests in expanding his business, buying properties, and enjoying a luxurious lifestyle, all while the origin of half his profits remains hidden in plain sight. By manipulating the paperwork of their sneaker trade, John, Crafty, and Sly have laundered $50,000 with ease. Smurfing. A technique where a large amount of illicit money is broken down into smaller, less suspicious amounts. These small sums are then deposited separately to escape detection, like a group of Smurfs working together. Meet Tony Pepperoni, the owner of a popular pizza parlor in bustling downtown Metropolis. While his pizzeria is a hit among locals, Tony has another source of income on the side: illegal poker games that net him huge amounts of cash. 1. The problem. Tony makes an extra $50,000 from these poker games every month. 1. Depositing this sum directly into his bank account would raise eyebrows. 2. The smurfing solution. Instead of making a single large deposit, Tony recruits 5 of his trusted buddies. 2. He gives each of them $10,000 with instructions to deposit them in different banks around the city. 3. Staying under the radar. Each buddy deposits the money in amounts of $2,000 to $3,000 at different times and different branches. 3. These smaller sums don't trigger any automatic reporting mechanisms at banks, and being distributed across various institutions, they escape attention. 4. Clean money returns. After the deposits, Tony's buddies write checks to Tony's pizza parlor for catering services. 4. Tony now has all his illicit money funneled back into his pizza business, looking as though it's revenue from legitimate transactions. 5. The perfect cover. As months go by, Tony's pizza parlor seems to thrive on paper with a booming catering business. 5. The illicit money, broken down and redeposited by a group of Smurfs, now appears clean and fully accounted for. By using the smurfing technique, Tony Pepperoni ensures that his side gig's profits are integrated into his legitimate earnings without raising any suspicion. The role of banks and financial institutions. While many banks have stringent anti-money laundering protocols in place, the vast and complex nature of global financial systems means that savvy launderers can often find loopholes or weak points to exploit. Example: the case of the offshore transactions. Let's consider the fictional Banco de Global, a major international bank with branches in over 50 countries. Given its widespread operations, it handles millions of transactions daily. To monitor these transactions, Banco de Global has an advanced anti-money laundering system that flags high-value and suspicious activities for review. John Doe, a savvy launderer, understands the bank system. Instead of making a huge deposit or transfer that would trigger an immediate flag, he opts for a more discreet approach. John uses several accounts under different names across multiple branches of Banco de Global in various countries. Each of these accounts receives periodic small deposits, staying under the threshold that would raise suspicion. The funds in these accounts are then transferred to an offshore account in a jurisdiction with lax regulations. Once in the offshore account, the funds are invested in a legitimate business, such as a chain of restaurants. The profits from this business, now seemingly legitimate, are then transferred back into a main account in Banco de Global, completely bypassing the bank's stringent AML protocols. By the time the bank realizes the pattern, John has already cleaned millions through their system, leveraging the complexity of international banking to his advantage. The global effort to combat money laundering. Organizations like the Financial Action Task Force have been established to combat money laundering. They set standards and promote effective implementation of legal, regulatory, and operational measures. Real estate money laundering illustrated. In the shady world of illegal dealings, those involved often accumulate vast amounts of money that can't be directly used or deposited into banks without raising suspicions. One such individual is Jane, who has acquired a considerable fortune from her secret betting operations. With this accumulation of illicit funds, Jane needs a way to integrate this money into the mainstream economy without attracting attention. Real estate, known for its significant transactions and sometimes lax regulatory oversight in certain jurisdictions, offers a solution. She embarks on a multi-step process to launder her money. 1. Property acquisition. Jane doesn't approach the property market directly. 1. Instead, she uses intermediaries, individuals or companies who act on her behalf, to purchase several properties using cash. 1. These third-party entities ensure her name isn't immediately linked to the sudden property buying spree. 2. Holding period. Once purchased, Jane doesn't rush to sell. 2. She holds onto the properties, sometimes renting them out, further creating an illusion of legitimate real estate activity. 2. This period can range from months to years, allowing any potential suspicion to die down. 3. Sale. After a certain period, Jane then sells these properties. 3. Given the appreciation of real estate value over time, she not only legitimizes her initial illicit funds but also often makes a legal profit. 4. Integration. The money received from these sales is deposited into banks, invested into other ventures, or used in ways that don't raise eyebrows. 4. On paper, and to any onlooker, this money is the result of savvy real estate investments, effectively masking its illicit origins. Through this meticulous strategy, Jane has effectively turned her illegal earnings from underground operations into legitimate and usable wealth, demonstrating the allure and dangers of real estate in the world of money laundering. In conclusion, money laundering is a complex web of strategies and methods designed to clean illicitly obtained money. With the evolution of technology and global finance, methods of money laundering have become more sophisticated. However, with coordinated international efforts and stringent regulations, the net is slowly tightening on those who aim to exploit the system. If you found this informative, please like, share, and subscribe. Thanks for your support.